Hey guys, hope you and the families are doing well. So there's a lot of trading indicators out there, right? MACD, stochastics, this and that. But what is the number one indicator in my opinion? The number one indicator, hands down, is the relative strength line, which you see here on my chart. This relative strength line and also these blue dots. It's a free tool. Search my name on TradingView. You will find it. Jack Corsellis RS line. I'm going to show you how I use it in conjunction with a high level understanding of price and volume. So it's price, it's volume, and it's relative strength. And I'm going to show the importance of really dialing in and focusing on relative strength. I'll take you through a stock HMY. I had a couple of trades in this one currently long at the time of filming this video, so you can really understand how to use relative strength in your own trading. MarketSurge are today's video sponsor. If you're interested in a discounted trial, then there is a link in the comment section and the description below. So this video is going to put a significant focus on the relative strength line and relative strength as a concept. Now I'm going to teach you how I apply it in my own trading, and you may find parts useful that you want to apply to your trading. So we don't just want to stare at the relative strength line being here, right? We're not going to get very far just staring at a relative strength line going, oh, it's going up, it's going down, there's some blue dots. We're not going to get very far, are we? What do we need to do? Well, we need to understand the price and volume action of the stock in conjunction with the relative strength and the relative strength line. So it's like a trio, right? It's price, volume, and relative strength of the stock and also relative strength of the group. Now let's just go back a step. Why is relative strength important? Think of it from a large operator standpoint, an institutional standpoint. What do they want to do? They want to outperform their benchmark. For many US institutions, that is going to be the S&P 500. So therefore, they want to be in areas and stocks in the market that are displaying relative strength versus their benchmark being the S&P 500. Now, why would they want to do that? Well, because if they are in things that are underperforming their benchmark being the S&P 500, guess what? They are not going to outperform their benchmark being the S&P 500. So what's going to happen to their assets under management? They're going to decrease. They're going to get sacked. People are going to take their money away from them and go put their money somewhere else to someone who is outperforming the benchmark, usually the S&P 500. So the real kind of smart money, if you like, the savvy institutions, where are they going to be? They're going to be in the areas which are displaying relative strength, delivering alpha versus the benchmark being the S&P 500. So this is why I put such a significant emphasis on relative strength, because I'm really trying to follow the footprints of the quote unquote smart money. Where are they? Where do I see them going? So then what I'm trying to do is I'm trying to go, okay, what are the groups, what are the themes displaying relative strength? Of late, precious metal miners have shown a lot of relative strength. Some AI related areas have shown relative strength as well. And then dialing it in and going, okay, what are the strongest groups within that theme, within that group displaying relative strength? So if it's precious metal miners, so like GDX showing relative strength, which it is, what are then the strongest gold miners from both a technical standpoint and also a fundamental standpoint as well? So ideally they're ticking the kind of canceling William O'Neill boxes, big earnings, big sales, big estimates near 52-week highs, all-time highs, institutional sponsorship, liquidity, quick, high 20-day ADR percentage, high 50-day average dollar volume, and then it's displaying relative strength, and the price and volume action is constructive. You still with me? So there's a lot that goes into this, right? It's not just, oh, relative strength, yeah, like that. It's not fluffy, it's not vague. It's very detailed, it's very specific what we are trying to do here. So if we take HMY, I've had a couple of trades in this one. So here, entry number one, I was in it, free rolled a bit by selling half of the position there and then knocked out as it pulled back down here, break even. This one here is then targeting it through the higher, this shakeout demand tail, cancelled the order. Primarily I use buy stop limit orders. It gapped above the limit on my buy stop limit order, which is usually 0.5% above the prior day's high, which is invariably gap down reverse bar, shakeout demand tails, trigger bars. And at the time of filming this video, I still have a long position in the stock following this gap down reverse bar. So I'm going to explain this in terms of the price and the volume action, but also using the relative strength as well. So if we just start from the left hand side, what I do is I like to tell myself a story. I don't know if it's the ADHD, how my brain is just wired and it works, but what I'm trying to do is I'm trying to tell myself a story. So from left to right, I'm not going from the right hand side to the left hand side. That may be going the opposite way on the video, don't know. But what I'm trying to do is tell myself the story of supply and demand from the large operator standpoint. What I'm really trying to do is follow the institutional footprint. I'm trying to go, I see them there, I see them there, I see them there, with the repeatable characteristics that I would associate with institutions accumulating positions, absorbing supply, shaking out retail weak hands. And then is it displaying a lot of relative strength? Do I see the money flowing there? So let's start working through that exercise, right? HMY over here, this is actually gapping out. of a pretty sizable base, multi-week, multi-month base over here. So you can see I call this bullish synchronicity. What is that? There is a synchronicity between the bullish price action and the volume confirming it. The black line that you see is the 30-bar average. So it's about 2 times the 30-bar average, gap up, open near the low, closing very strong, and then it pushes up in subsequent sessions. Pulls back down, shakeout demand tail. If you're not familiar with the terms of shakeout demand tail, gap down reverse bars, trigger bars, there is a video on the channel called the Blueprint video which explains my process. I talk about them in a lot of other videos. So then it holds the 10-day EMA. That's what we'd like to see a leading stock do. And then you can see a really nice rally here. So the stock goes from circa $5.50 up to a high there of about $9.70-ish. Okay, that's a decent move. Then look at this here. So this is the relative strength line of HMY versus the S&P 500. If you want this indicator, search my name in TradingView. It's this one here, you'll be able to find it. What do you notice? It's really strong. And these blue dots, these are blue cherries, 52-week highs versus the S&P 500. I really like to see those. So one of the strongest signs of strength you can possibly see for a stock, for a group ETF, for a theme ETF, and obviously the more stocks within the group hitting 52-week highs on the relative strength, to me that's a better indication that, wow, the group is really strong here. So what I like to look for is 52-week highs on the relative strength line, pre-base, if they hit them in the base, even better, and then post-base as well. If the stock starts breaking out from a continuation base, invariably for me, that's going to be flags, wedges, pennants, cup and handles, VCPs, ascending triangles, symmetrical triangles, Darvas boxes, all that good stuff, right? But this is what I'm on the lookout for, these blue dots. Why? It tells me there is outperformance there. And if I'm seeing outperformance in terms of the group ETF, in terms of if it's a theme like, say, precious metal miners, or maybe it's like AI related stocks, if I'm seeing it in basically the more the merrier, right? The more precious metal miners hitting 52-week highs on the relative strength line as they're rallying then into their bases, and then they start building flags, pennants, wedges, VCPs, cup and handles, all of that good stuff. I just give that even greater weight. Like even greater weight to say, hey, there is outperformance here. I think the smarter institutions are going to be going to this area of the market where there's a lot of relative strength. And then it's a case of, okay, am I seeing their footprints? Well, I think I'm seeing their footprints here at the beginning of the rally. Look at this, how it just rally, stays above the 10-day. It's not chopping around all over the place like this. It's a really nice trend. Like that from a trade management standpoint. So I may be using the 10 or the 21 as a trading stop on this stock. Then if we take a look at the S&P 500, so if you look at where this rally starts from, let's go from the day before. So let's go from the 1st of March, right? HMY goes from here to here. What is, during that same time period, what do we see? Let's go from the 1st of March. They're not perfectly lined up over there. That's a little bit annoying. From here to here. You see how the index is flat to marginally down, right? It's just not gone anywhere. If we just maybe do this in like a color, see how the S&P 500, it's just not gone anywhere. So where do the institutions want to be? They're greedy. They want more assets under management. Where are they going to be? Are the really smart ones, the quote-unquote smart money, are they going to be in something that is lagging the S&P 500 for prolonged periods of time? No, because they're going to underperform their benchmark. They don't want to do that. They will get sacked. They will lose assets under management, and that money will be taken from them, and it'll go someplace else, to another institution, another fund, whatever it may be, that is outperforming the benchmark, invariably the S&P 500. So this is why they are dialed in and they are focused and going, okay, where's the relative strength? How can we produce the alpha? How can we beat our benchmark? They're going to be in things that are displaying relative strength to their benchmark. So if they're trading in the UK market, the benchmark is going to be different. If they're trading in the Indian market, the benchmark is going to be different, right? But we're specifically talking about US here. So S&P 500. So what do we see? Look at the relative strength coming through. You're going to have different institutions. You're going to have institutional trend followers start jumping on these when precious metal miners start trending up as well. So there's lots of different kind of large operators within the market. But the really good ones, they're going to go where the relative strength is. So then it's the question. Now we understand the importance of relative strength because they don't want to get sacked. They want more assets under management. We're trying to follow the footprints. So okay, we spoke about some of the footprints here. So as this base starts building, so this is basically going to be this blue zone, okay? As this continuation type base starts building, so for me, continuation bases, they're going to take the form of mainly flags, wedges, pennants, VCPs, cup and handles, Darvas boxes, ascending triangles, symmetrical triangles, whatever you want to call them. I don't mind what you want to call it. I don't care what you want to call it. It's just the label. What I care about, price, volume, relative strength. And it's not just what's happening, where is it happening? It's not just what's happening, it's where is it happening. So then I'm trying to follow the institutional footprint. So for me, they leave footprints. And the footprints will often form or resemble shakeout demand tails, which is variations, so SDT, shakeout demand tails, which are variations of hammer candlesticks, Takuri lines, and doji dragonflies. Gap down reversal bars, such as this bar here, where the prior close is here, where it gaps down, opens pretty much on the low and reverses up. Gap down, reversal will take the form of bull piercing patterns, meeting lines, frostings, bullish engulfing candlesticks, belt hold bullish. Love seeing those. This over here, where I then took the entry, this is a bullish engulfing candlestick. Gap down, open on the low, hardly any volume, and then it just reverses around the 10 and 21. But it's not just what's happening, it's where it's happening. So now we start going into the weeds, okay? This is where this video is going to get very, very detailed very, very quickly. So we can see HNY, nice rally displaying a lot of relative strength, as is GDX, as is a lot of precious metal miners, and GC gold futures is looking very, very constructive at this moment in time. Let's just pull back down to its 21-day and 10-day, nice clustering. And then the stock is still displaying relative strength within the base. It's kind of holding flat, right? So as the index is rolling out of bed here, see the S&P 500, it just rolls out of bed, loses the 10, loses the 21, loses the 50, which is the purple line there, just slices through it like a hot knife through vegan butter, right? See that? Just to the downside like that. What does this stock do? What does HNY do? Well, the 50 days here, does it get anywhere near closing below its 50-day? It doesn't get anywhere near it. So while the index is displaying all of this weakness, what's HNY doing? Nah, I'm just gonna pull down to the 21-day EMA, which is going to be a real sweet spot for many stocks in the market, 21s, 50s, but really 21s, that's going to be a real sweet spot where we're looking for when a stock has displayed a lot of relative strength, that 21, we're then looking for the footprints, right? Which are going to resemble, in my view, shakeout demand tails and gap down reverse bars. If you understand them from a supply and demand perspective, shakeout demand tails and gap down reverse bars in the right context indicate institutional accumulation and absorption of supply and shaking out retail traders' weak hands. Because they usually go and undercut key moving averages, such as a 21, recent lows where there may be a load of stop losses as well. So now we start diving in to the base. So a stock is displaying relative strength. We're now looking for the footprints, okay? To go, okay, are the large operators still in here? Does it look like they are accumulating and absorbing supply, or does it look like they're distributing? When we start looking in here, you get this, the first one, right? Shakeout demand tail, gap down, scary, right? I mean, this stock gaps down pretty big from the prior close, gaps down around about 6-7%. That's not far off 2 times its 20-day ADR%. That's a big gap down. But where does it gap down to? Interesting. The 21-day EMA. And then what happens? This is about developing a Bayesian mentality. You update your decision-making process when new information becomes available. New information is now available. What are you going to do with it? What are you going to decide to do? Gap down. Looks horrendous. Right on the open, you're like, well, this thing's just selling off. When it's on the low down here, this looks horrendous. The bar will look like this, which is very distributional. But no, there's not that much volume. But what happens by the close? Oh, shake out demand tail. And see how it just undercuts the last 2 weeks, 3 weeks of lows and gaps down to the 21. What do you notice about the volume? It's below the 30-bar average being that black line. What does that tell you about how much supply, how much selling is at these levels? Not much, because that's a big gap down and there's not much volume coming through. Next bar, gap down reversal. So then the prior close is here, and then it gaps down, opens on the low of the bar, pushes up and reverses on volume below the 30-bar average. What are those 2 bars telling you that large operators are doing? Let's shake those weak hands out. Let's scare the hell out of those retail traders. But how much supply is coming to the market? Not that much. Is that constructive? Yes, it's very, very, very constructive. And then you get what I call a trigger bar, which often resemble tight low volume inside bars sitting around 1 or more key moving averages. Tight low volume inside bars sitting around 1 or more key moving averages. This is the Minervini concept. Volatility, contraction. Toby Corbell, the market moves, stocks move, financial instruments move from periods of contraction to expansion. So here is the contraction. So that trigger bar on that low volume where the volume just dries up tells me what? There's not much supply around, and it's right around the 21-day following a shakeout demand tail and a gap down reversal bar. And the stock has just displayed a tremendous amount of relative strength getting to this point, and now the large operators are shaking out the retail traders, the weak hands. Get them gone. Liquidity and perceived value. 2 things large operators require above everything else. Then over here, so this one here, I took it here, sold half of the position to free roll it, and then I got knocked out break even here. Guess what? Every trade doesn't work. But that's fine. You're trying to think over a series of trades, hundreds of trades, thousands of trades. And then over here, let's go more into the psychology. So it pops up here, pulls back down, and now you get another shakeout demand tail just underneath the 1021. Okay, the index is still just down here underneath the 50. Has HNY come anywhere near the 50? Nowhere near. and look around the lows. It's the institutions that create the lows of the bases, guys. So look at this, right? What we're going to do is we're just going to pull this across. Okay, look at this. Shakeout demand tail bar. I'm going to point to the volume as well. You get this shakeout demand tail bar that undercuts all of the base lows so far. So imagine if someone is buying it, say coming through here, where are they going to place their stop loss? I don't know. Just underneath there. There you go. As those stop losses hit, it's the institutions that create the lows. So you want to understand the games. You want to understand the footprints. The footprints for me resemble shakeout demand tails and gap down reversal bars most commonly. This is what they look like. This is the games that get played. You want to be aware of this. So I'm targeting it through the high. I primarily use buy stop limit orders, limit 0.5% above the high of the trigger bar, gap down, reverse bar, shakeout demand tail, the prior day's bar, basically when I'm then buying it. This here, it gaps up way above where my buy stop limit order was. I mean, it gaps up around about 3.5%, never pulls back down to that range. I don't get filled. So that's fine. I just cancel the order there. But the reason I'm then targeting it through there is I'm going shakeout demand tail, undercuts all these base lows. There's no volume. Well, there is some volume, right? It's just over half the 30-bar average, but what's it? There's just not that much supply. And I'm going, this looks like large operators want it here. Great trend. And then I'm looking at the base, which I don't care if you want to call it a flag, a wedge, a pennant, a VCP, a couple handle, a Davis box, ABCXY. I do not care. Don't care. What I care about, price, volume, which is supply and demand, and relative strength. Look how the relative strength line is just subtly ticking up here. The gap's then ticking up into this gap down reversal bar. It's okay, cancel the order there. Then it pulls back down. And then you get this bar, gap down reversal bar, that now puts in a structural higher low. Higher lows are bullish. So you think about it. It tries to go here, pulls back down, puts in a higher low, gap down. This is subtle. This is subtle, but super important. Do you see where the low of that bar is? And you may be like, well, the low of the bar is $8.65. No, you missed the point. The low of the bar is the open of the bar. Think about it. Gap down just underneath the 21, which is going to be a sweet spot. That's an area, a region that we are looking for the footprints, which the footprints, in my experience, are going to look like shakeout demand tails and gap down reverse bars around 10 days, around 21 days, around 50-day moving averages. But the fact that the open is the low of the bar and then it pushes up. Gap down, reversal bar, but the gap down and it opens on the low and pushes up. And what do you notice about the volume? There's not that much of it. It's about half the 30-bar average, if not less. So what does that tell you about how much supply is there? How much demand did it take for this stock to push it up? Not that much. So I call this bullish ease of movement. So it's a gap down reversal bar with an ease of movement to the upside. It's just saying, hey, there ain't that much supply around. There's not that much selling around. So it's never just one thing. It's a combination of things. What you're trying to do, for me anyway, is I'm trying to go, okay, where's the strength in the market right now? And it wiggles and jiggles, it changes. If you think precious metals is going to be the next big thing for the next 5 years, I think you're sadly mistaken. It doesn't work like that. Areas of the market, themes in the market, stocks in the market have bouts of relative strength, and then they don't. Okay, they base, they trend, they top, they go away. Maybe they come back, maybe they don't come back. I don't care. It's just on to the next thing. So it's about doing the work every day and going, okay, where's the relative strength right now? With the information I have available right now, where's the relative strength? Where are the best opportunities? Because relative strength is not my opinion. It's not your opinion. It's the opinion of the market. And the market's favorite things, in terms of groups, in terms of themes, in terms of individual stocks, in my experience, will display the greatest amount of relative strength, and you will see the games. Okay, once you open your eyes to it and you start understanding the psychology behind the charts, what is going on from a supply and demand perspective? What's happening in terms of relative strength? It's not just one thing, it's a combination of things. And then where are the things happening? So here we have clear evidence, large operators want it. Look at the rally, well, the S&P 500 goes nowhere. Look at the relative strength. And then it's about looking for the footprint, looking for the footprint, looking for the footprint, and going, okay, interesting. Shakeout demand tail, that would have scared out a load of weak hands there. Oh, but there's not much volume. Then what follows it is gap down reverse bar, then a trigger bar. There's a ridiculously good setup. And just because you identify a ridiculously good setup, it doesn't mean that it's just going to go up 100%. The market doesn't work like that. And then you get the shakeout demand tail just underneath the 1021, holds above the 50 while the market has just been absolutely nowhere and below the 50-day, undercuts base lows, undercuts the last 4 or 5 weeks of lows. So imagine anyone that had a stop loss, right, watch this. Anyone that had a stop loss, watch this, right? This is, hopefully this will like just drum the point. I know I repeat things, right? I repeat. Why? Because repetition is the mother of skill. Like, you got to be really specific in terms of what you're trying to do and then get better at it. Create feedback loops for yourself. Realize trading is a skill set. You can get better at it. So with this shakeout demand tail here, right? Anyone that has a stop loss in this blue zone is just got to shake it out. And it undercuts the lows. So it's not just what happens, it's where it happens. Oh, okay, it's a shakeout demand tail. Yeah, but it's a shakeout demand tail that undercuts the lows just underneath the 1021 while the stocks displayed a tremendous amount of relative strength. The RS line is actually ticking up here too. And the volume is, there's sweet FA. There's hardly anything. There's just no supply at these levels. Hardly any selling. It's fantastic. Pop comes back in, textbook gap down reverse bar, through it goes. So for me, every session, I am trying to plan and prepare as best I can for the next session and really focus on where is the relative strength in the market? What are the groups? What are the themes displaying relative strength? And then dial it in and go, okay, within those strong areas, whether that's precious metal miners, AI stocks, semiconductor, whatever it may be, where are the leaders? Where are the leaders from a technical standpoint? Where are the leaders from a fundamental standpoint? So the fundamentals are looking at the EPS, the estimates, the earnings, the sales, institutional sponsorship, near 52-week highs, all-time high territory. The technicals is this. And a lot of it is that trio: price, volume, relative strength. What's happening and where is it happening? So I really hope you guys have enjoyed that video, and that's kind of taken you a bit more into a deep dive in terms of, yes, looking at the relative strength line, but thinking about the context of the relative strength line. What is the stock doing when the index is doing certain things? Is the S&P 500 losing the 50 and this stock saying just, no, we're just going to hold up way above the 50? The institutions just don't want to get rid of it. And then looking for their footprints, looking for the institutional footprint, realizing the games that they just play time and time again. So thank you very much for watching. Thank you very much for supporting the channel, and I look forward to seeing you in a future video.